Hello everyone, this will be the last topic for BU 483 for the spring 2020 semester. In this topic we're going to go through the Black-Scholes option valuation, and specifically we're valuing options using the Black-Scholes option pricing model. This isn't the only way to value options, but it is the most used way, most common way that we see people value options. The other primary way to value an option is a technique called binomial option pricing. It is similar to the Black-Scholes model. The Black-Scholes model just automates a lot of the processes you do in the binomial option pricing model, and it assumes that the repricing or the ability to reprice options occurs continuously, where the binomial option pricing model does not assume that. So the Black-Scholes option pricing model, to give you a little background, Fisher Black and Myron Scholes started working on this in 1968. They kind of finished the model and they published a paper in a prestigious journal in 1973 over their model, explaining how their model worked. The same year, the Chicago Board Options Exchange opened. I don't know. I think this is probably not a coincidence, because before that, using the binomial option pricing model, it was difficult to value options. This really made option pricing a lot easier. So in this lecture, I'm going to go through a small amount of notes on the option pricing model, and then what we're going to do is we're going to open Excel up. I'm going to show you how to create this model in Excel. Typically in a classroom, what I would normally do is have you work it out by hand. I think it's useful in terms of learning the model to do that. However, when I use this model, I do it in Excel. And so I'm going to show you the way that I use this model, and then we're going to go through the different the variables and how those variables relate to the value of an option. So I've got the variables all up here. And in Excel, I will demonstrate all of these, but let's just go through them. So this is for a call option, and this is for a put option. So if this variable increases, the value of the call option, so if the stock price increases, so the price of the underlying stock increases, the value of the option call option goes up, the value of the put option goes down. If the exercise price decreases, which doesn't happen after the option's been issued, but if an option is issued with a lower exercise price relative to other options, the value of the call option, if the exercise price increases, the value of the call option decreases, the value of the put option increases. Volatility, and this is the one that is kind of strange, because it has the same effect on both the call and the put option, where in other cases, with the exception of one other case, they move opposite to each other. So the value of both types of options increases with the amount of volatility of the underlying stock price. So the more that stock price moves, the bigger the movements in the stock returns, the greater the value of both the call and the put option. And the idea here is that the greater those movements, the greater the probability of achieving extreme either high values or extreme low values when those options are going to be worth more. The time to expiration, again, for both the call and the put options, the longer the time to expiration, the greater the value of the options. And again, for the same reason, for both options, the longer you go out until the expiration date, the greater the chances of an extreme value to occur where that option is going to be worth the most. The risk-free rate, if the risk-free rate increases, the value of the call option increases, because the idea here is that will also cause returns to increase and stock prices to increase. If the risk-free rate increases, the value of the put option decreases. And then dividend payouts. So we know with dividends, when dividends are paid out, or actually on the ex-dividend date, that the value of the stock drops by the value of the dividend. So if you have something that's going to cause a stock price to decline, such as a dividend payout, then the value of the call option will also decline, because that reduces the value of that stock. And likewise, it causes the value of a put to increase, because put options are worth more when stock prices fall. All right. And again, we're gonna go through those different relationships when we work this out in Excel. So restrictions on option values, restrictions on the value of a call option. So the price of a call option is bounded on the bottom by 0, because people aren't going to pay for you to buy call options from them. They want to sell those. And bounded on the top by the stock price. So essentially, if the stock price, if the value of the call option were the stock price, it would have an exercise value of 0, or a strike price of 0. So that's kind of the situation there. Another lower bound and more realistic bound on the price of a call option is calculated as the value of the call option, that's C, is greater than or equal to the value of the stock price today minus the strike price plus the dividend divided by 1 plus the risk-free rate raised to the power of the time. And what's key here is the dividend, where D is the value of dividends paid right before the expiration. So let me explain why. If you think back to the last section when we talked about exercise values, we knew the exercise value of a call is equal to the maximum of 0, or S minus X. And I might have put that the other way. Let me just do that. S minus X, or 0. Okay. And that's on the date that you exercise the option. Or in the case of it being worth 0, that's the case on the expiration date when it has no value. So in this case, all we've done is we've included the issue of the dividend, and we've discounted that value, that strike price, back to today at time 0 by the risk-free rate. So X minus D, the value of D is up here because as the person who has purchased the option, I'm not going to receive that dividend. Okay, so if the dividend is paid right before the expiration date, I assume I'm not going to receive that dividend, and so that's a cash flow I won't get. That's going to go to the person who sold me the option, plus the strike price, which I'm going to pay to the person who sold me the call option. So it's S minus X plus D, and what we're doing is we're taking those values back to today at discounted back at the risk-free rate. So that's why that relationship holds, is because it's really this relationship brought back to today, or whatever date we're looking at, and also including the dividend, which will come out of the value of the stock before we, as the option holder, gets it. Okay. So early exercise in dividends. It may make sense to exercise a call option early if the ex-dividend date on the option is near the time of maturity, the option is deep in the money, and the option has a delta of 100, meaning that a $1 increase in the stock price results in a $1 increase in the option value. Otherwise, early exercise of a call option would generally not be profit maximizing. And the reason why we don't want an early exercise of an option is the longer that option is out there, the greater the chance that the stock price is going to go up to the point, and as it goes up, I maximize the value, the exercise value that I'm going to get as that option holder. So only in very specific circumstances would it make sense to exercise that option early. Exercising a put option makes sense if the stock value is at or near 0 due to bankruptcy or the threat of bankruptcy. So again, if the stock value is near 0 or the company's gone bankrupt, you're not going to earn more money by waiting. Okay, so if a company goes bankrupt, let's say I bought a put option, the company goes bankrupt, the stock is worthless, that's where I make the most amount of money if I own that put option, because the person who sold me the put option is going to have to now pay me the maximum amount, whatever the strike price is, because the underlying stock is now 0. If call options are not exercised early, there is no difference in pricing between an American and European options. And I went through those in the last video, but just as a a reminder, an American option is an option that can be valued at any time, or excuse me, exercised at any time, and a European option can only be exercised on the expiration date. So the Black-Scholes option pricing model prices options with the assumption that they are only exercised on the exercise date. If you want to look at exercising it early, that's where a binomial option pricing model would come in. So here's the model itself. It's kind of complicated. I'm going to walk you through the equations, and then again we're going to actually work out problems in Excel, and I'll show you how to set up the entire spreadsheet. So it looks like this. The value of our call option C is equal to, and I want you to remember those exercise values that we learned about in the last video. So the exercise value of a call is equal to the maximum of the stock price minus the exercise price, or the strike price, or 0. So if you take a look at this and strip out all the other stuff here, you have S here, minus X here. So the value of the call is equal to the stock price today, and then this K is the dividend yield, so the dividend yield discounted back to today multiplied by ND1. And ND1 is a probability that we're going to get from D1, these calculations below. D1 here is our probability for that, minus X, and then we're discounting back at the risk-free rate, multiplied by ND2. The way we calculate D1 is we take the natural log over the stock price divided by the exercise price, plus the risk-free rate minus the dividend yield plus the standard deviation of the stock returns squared divided by 2. So it's the variance divided by 2. And that argument there multiplied by the time in years to expiration. And then the denominator is sigma multiplied by the square root of time. So if you go way back in your notes to the first lesson, you'll see where we talked about this briefly. At the end of that, when we talked about stock returns and you know how they look, what they look like, this sigma multiplied by the square root of time showed up. So that's how we get D1. D2 is equal to D1, the value we get here, multiplied by sigma times the square root of time. If you ever want to know how to derive this, I'm happy to give you that information. I actually, when I was getting my PhD, I had to take 2 classes on this topic, where we, and during one of the classes, all that we did for an entire semester was derive, using calculus, deriving these different formulas for the option pricing model. That was just exciting. I won't put you through that though. But this is how it's priced. Okay, this is what we use to price it. We've got S minus X. We associate different probabilities with S and X. And really what we're looking for is the probability that S will exceed X at the expiration date. Okay. And by how much. So note that the closer that ND1 and ND2 are closer to 1, the greater the probability that the option will be exercised. Most of the inputs are easy to determine. The stock price is just the current stock price. The exercise price and the time to maturity are given with the terms of the options. The risk-free rate is the money market rate for a maturity equal to that of the option. The dividend yield is easy to predict over short horizons. And let me explain that risk-free rate. So that's the rate we could invest our money in putting in a risk-free asset for until the time to the expiration date. The volatility of the underlying stock is sometimes difficult to determine. Many analysts use annualized standard deviation of the stock over the past 30 to 90 days. However, historic standard deviation may not be representative of the standard deviation for the stock between now and the time to maturity. The implied volatility of an option can be determined for an option that is currently trading by filling in the option price and solving for volatility. It is usually done using a program or a spreadsheet. We're not going to do that, although it's pretty straightforward to do it. So I'm going to stop there for a second, and I do want to show you something. So out here on Yahoo Finance, so I pulled up Walmart here on Yahoo Finance, and then you can just select options here, and you can look at the options that are out there. So we've got, and this is just for Walmart, so you can see there are tons of options out there. These are the ones that expire in 2 days. I'm recording this on April 22nd. You probably put it out, I'll probably put it online tomorrow on April 23rd. So they're expiring very soon. I want you to look at the implied volatility here. This is huge. These volatility numbers are extremely high. Okay, so this is the standard deviation of the stock. It typically is how we're going to get these numbers. You can see they're kind of all over the place, but they're also very large. 100% standard deviation is quite large for these stocks. These are the in-the-money options. The blue ones, blue highlighted ones, are in the money. The white ones are out of the money. So you can see for some of these, the implied volatility is incredibly high. And that's as a result of the volatility in the stock market over the past month or so. That has caused that implied volatility to be very high. You might think back to the beginning of this lecture when I talked about an increase in volatility increases the value of the option. So if you purchased a stock option, a call option, or a put option prior to kind of the whole meltdown happening over the coronavirus, the value of your options would have gone up tremendously because you have a greater chance of a greater payoff as a result of that volatility. Okay, so, and you can change it here. We can go out and look at options that are expiring in a few weeks out to a couple of years. The open interest here is the number of contracts that are outstanding. In other words, someone bought a call option, that would show up here, and they're out here. That open interest is out there until the option is closed out. In other words, until the person who purchased the option exercises the option or does a transaction that reverses their position on that option. And so you can really see here where there's a lot of open interest. There's probably a lot of, the idea is that that's an area, that's a price at which, or the strike price is a price at which a lot of people might expect some activity to happen. So we can see right here a tremendous amount of open interest on this 130 strike price. A lot of volume, a lot of options are being traded at a strike price of 145 for the January 15th, 2021 expiration date. So put option pricing. The value of a put option, again, remember the exercise value of a put option is equal to the maximum of X minus S, or 0. And we can see that again down here. X minus S, and then we're discounting everything back to today, and and then we have probabilities here. Notice that it is negative ND2 and negative ND1. This valuation here is valuation using put call parity. I'll show you how to do it both ways in the spreadsheet. I typically go ahead and just use this put call parity method. It should give you the same outcome. But I usually have, in the spreadsheets I make up, I usually have the call value already, so it's easy to just plug this into another cell to get the put value. The Black-Scholes model provides the price of a European option rather than an American option. For a call option, the difference in value is generally not meaningful. However, because an American put option is more likely to be exercised early when compared to an American call option, the Black-Scholes model price for an American put option is a floor of the valuation of a put option. So because people that hold put options might exercise early in cases where the firm has taken a big hit right after the ex-dividend date, when the stock price falls, actually on the ex-dividend date when the stock price falls, or if the company just goes bankrupt. There's oftentimes a good time to exercise it early for a put option. And so really that the Black-Scholes put value price is the minimum price that option should sell for. I have one more thing down here, and I need to, when I originally made up these notes, I made them up for working in class where we would have worked through some problems there. But again, I'm going to show you how to do this in Excel instead. So empirical evidence on option pricing. Empirical studies on option pricing shows that the Black-Scholes model is fairly accurate in determining option prices. I'm not going to even try right now because of the extreme volatility in the markets, but typically we can go out and we can find options that are being traded that have a lot of volume, that are fairly liquid out there, and the values we'll get using the Black-Scholes option pricing model tend to be pretty close to sometimes very close to the values we actually seeing them traded for in the marketplace. One fault in the model is that it assumes that the volatility will be the same for all options with the same stock and same maturity date regardless of the strike price, and we actually saw out when we looked at the Walmart options that the implied volatility, so the value that is in the model, is not the same. That can vary quite a bit. Empirical studies show that the implied volatility for put options decreases with an increase in the strike price to stock price ratio. Prior to the 1987 crash, and that was referred to as Black Monday, if you ever want to look that up, there was just a big crash in the stock market, and as a result of that, new rules were put in place about how much the stocks can fall before the market has to shut down and take a breather. The implied volatility curve with the maturity on the same stock were flat. The change in the implied volatility across different strike prices has been attributed to the market, including the probability of another black swan event, which was an extreme event, and it probably what was seen just in the last couple of months when we had very large stock price movements that fell out of the range of normality for the stock returns on a given day. So those black swan events, those extreme, the probability of an extreme change in stock prices and stock returns in a short amount of time is actually shows up in option values, but is not in the Black-Scholes model. Okay, so the Black-Scholes model assumes normality for, well, log normality for stock returns. All right, so let's go to a spreadsheet here. Well, actually, first thing I want to show you is this Z distribution table. So normally what we would do is we'd calculate by hand that D1 and D2, and we would actually look up D1 and D2 on this Z distribution table. Okay. But we're not going to do that instead. But we did want to show you this. You know, if you're familiar with statistics, this is going to be the values that you would look up for a z-test, a statistical test to determine whether or not something is statistically significant. So what we're doing here is something similar to that, and I'll show you how to get that result in Excel here. I'm just starting with a blank worksheet. I encourage you to do this too. You should expect to see this, and I'll have you work problems in Excel for your final exam. In the past, I've given an assignment on this, the assignment that you are hopefully completing. One time I replaced that assignment with a Black-Scholes option pricing assignment on Excel, and students seemed to really like it, and they told me they like that instead of the other assignment. And what I found out though was on the final exam that students didn't do very well on those option strategies, identifying and determining the resulting value of and profit from those option strategies. So I went back to that assignment that I've given you, and this one I'll give you some problems on your final exam to work through in Excel here. So let's go ahead and let's put in the different variables that we need. So we need the current stock price, we need the strike price or the exercise price, we need the risk-free rate, we need the time in years, and this is the time to the expiration of the option. We need the dividend yield, and then we finally need the volatility or the standard deviation, or the implied volatility. Okay, so we have 6 different inputs. Now I'm going to name these cells over here because I find it's just easier when I'm putting in a formula as complex as the Black-Scholes option pricing model to just be able to type in names. So up here in the name box, put in stock price. Okay. Oops, not where I want to put it. And you don't have to use the same names as I do. Just know what they are. Strike price, risk free. You can notice I'm not putting any spaces in these. Time, div yield, and then finally volatility. Okay. So now to me it's so much easier to calculate these. The first thing we want to do is calculate D1 and D2. So I'm just going to put here D1, and then going over to this formula here, you kind of have to be careful. I always get kind of tripped up with parentheses. So I'm going to put in here equals and then open parentheses. Although there's not a parentheses beginning with this, I put the entire argument in parentheses and then divide by this number in parentheses just to keep the order of operations correct. The natural log of the stock price divided by the strike price, close parentheses, plus open parentheses, the risk-free rate minus the dividend yield plus open parentheses volatility up caret, so that's a shift 6 squared divided by 2, close parentheses, and I want to put 2 close parentheses there because I want to contain this entire amount, so just like it is here. And I'm going to multiply that, everything in those parentheses, by the variable of time. Okay. And then I'm going to put another close parentheses, and that takes care of my numerator, divided by my denominator is volatility, and I put an open parentheses there again, multiplied by the square root, so SQRT for square root in Excel, of time. And again, I'm just using this value over here. Close parentheses, close parentheses. So there's my D1. So I'm going to put in some values here so this doesn't look so bad. We're going to say we've got a stock with a price of $50. We'll make this one at the money for right now. Risk-free is $50. My risk-free rate is, let's say, 3%. My time to maturity is 1 year. My dividend yield is 2%, and my volatility is 30%. So I get a D1 of 0.18333. And we would expect this to be positive because it is the D1 to be positive because it is an at the money call option. Now if our dividend yield got too high, it would become negative. So I'll put in here 0.12 and see if we get a negative one there. But most stocks don't have a dividend yield of 12%. Okay. So and if our dividend yield 0, you see it goes up. Now if the call option is too much out of the money, that D1 is going to become negative, and doesn't mean anything, doesn't mean it's wrong. It just decreases, means that the value of the call option would be smaller. So my stock price, let's say it's 30 instead of 40. See, it's very negative in this case. Okay. And as we get closer and closer to being in the money, we get more positive. Okay. So we've got our at the money option right there. D2 is pretty easy to calculate. Oops. If I type it in right. So D2 is equal to the value we get for D1 minus the volatility multiplied by the square root of time. It just equals that minus volatility multiplied by the square root of time. Okay. All right, and so now we've got D1 and D2 calculated. Now we're going to determine the value of the call option. So my call value is equal to the stock price multiplied by EXP. So you see that E to the dividend yield multiplied by time, we get that by EXP. And then in parentheses, we're going to put negative div yield, because that's what that K is, multiplied by time. And then we're going to multiply that. We're going to put a function in here called norms dist. And really what we're doing there is we're looking up the value in that Z table that I showed you before. The value of Z in this case is going to be D1. So it says ND1. So we're just putting norms dist. And make sure that S is in there or you get a weird something else that you don't want. Okay. So now I've got S e to the negative KT multiplied by ND1 minus the strike price multiplied by EXP, negative risk-free, multiplied by time, multiplied by norms, dist, and D2. And that is our call value formula. Okay. So our call value in this case is $6.64. Our put value, so if we use the same inputs for a put where the strike price is 50, the stock price is 50, so it's an at the money put, and all this other information is the same. I'm going to, and again there's two different options here, and I'll just show you both of them. We'll use this one first. This is the put call parity valuation. So we take the call value, we subtract out the stock price, multiplied by the exponent, negative div yield times time plus the strike price multiplied by EXP again, negative risk-free, multiplied by time, and that's it. So this is my put value. Notice that the value of the put is less than the value of the call, which is the case most of the time, especially if there's no dividend. Well, it's the case all the time in the case of no dividend, for an at-the-money call or an at-the-money put. The value of the put will be less than the value of the call, and that's because there's an expectation, especially if the risk-free rate is positive, that the stock price will trend upwards over time. So here I put the risk-free rate as 0, and they're worth the same value. So that risk-free rate, a positive risk-free rate, indicates that the value of the option, or the value of the underlying stock, will increase over time. So that's how we calculate the put value using the put-call parity formula. So this is put-call parity. And then the other way of doing that, I'm just going to do that for you here too. Put value. So I'm using this formula now. So again, x minus s here. The one thing I usually get tricked up if I'm doing this by hand is I forget to make the D2 and the D1 negative. So we'll make sure to do that in this case. So we have equals strike price multiplied by EXP negative risk-free multiplied by time, close parentheses, multiplied by norms dist, norms dist, and now we're going to put in negative D2 minus the stock price, not stock price, stock price, multiplied by EXP negative dividend yield multiplied by time multiplied by norms dist negative D1. That's it. Okay, we get the same answer. So that is how we value a call option and value a put option using the Black-Scholes Option Pricing Model. So now let's go through these different variables and see how a change in the variable affects the change in the value of the option. Okay. So for this I'm going to use data tables, and I demonstrated how to use these with your last assignment. And so we're going to use them again. I use them a lot. I think they're very useful. So here's what I'm going to do. I'm going to put in the call value. Actually, I'll put it over here. Call value, put value. My first one will be stock price. So here I'm going to make this equal to the call value. Just set it equal to that call value there. Put value, set this equal to either one of those put values. They will come out the same. Now I'm going to put in values for the stock price. And so we'll start with $10 and go up by $5 increments. So I'm just going to do some of those, and then I'll pull it down. So I'm going to take that out to $100 a share. Okay, and so now I'm going to highlight all of this, go up to data, what if analysis, data table. My column input cell is going to be the stock price because that's the value that's changing in the column here. And so now I'll make this look pretty. So one thing to point out, I'm going to hide this, is that the call value doesn't have any value. Okay, there is no value to the call until the stock price gets up to $25 a share. Okay. Likewise, the put value never goes to 0, but it gets pretty darn close. So we're starting off with a $100 value for the stock price, and the strike price is $50, meaning that this stock will have to go down in value by $50 in order to start having any value for the put investor. Okay, so now last thing I'm going to do is put this in a into a table here, and so again you can see I don't like that. That's where it's coming from there. There we go. Yeah, I got rid of it that way. All right, so this is a change in the option values, or option values. So we can see here as the value, the stock price goes up, the value of the call goes up, the value of the put goes down. So that's what we expect. Oops, didn't mean to do that. So let's go to another, the next variable here is strike price. Again, I'm just going to set it up the same way. So again, the call value, the put value, put those values in there. I'll format these to make them disappear. And I just put 2 semicolons in for that. Highlight it all. Or just the numbers. I don't highlight the labels here. Go to Data, What If Analysis, Data Table. My column input cell in this case is going to be the strike price. And then again, do that. And so again, we can see here as the strike price increases on that call value, the value of that call option goes down. As the strike price increases for the put value, the value of the put option goes up. And so this is option values and strike prices. Our next one is the risk-free rate. So again, this one's a little weird, and honestly, as in my classes that I had to take and prove, so part of my comprehensive exam for my PhD was actually proving all these relationships through mathematical proofs rather than just showing the answers here. I had to demonstrate all of these relationships, and the risk-free rate one was kind of the strangest one, because as the risk-free rate increases, that increases required rates of return, and subsequently also decreases the value of stocks. So it's kind of a strange one in that case, where an increase in the risk-free rate can have the result of decreasing the value of stocks, but increasing the value of the call option. So this is the risk-free rate. Again, we've got our call price, our call value, our put value, so I'm going to start with a 0% risk-free rate. And we're going to just go up by 0.5% each time. Okay, we're going to go up almost to 10% there. I could just take it to 9%. How about that? All right, and so then I'm going to put in, again, I just put that equal to the call value. And set this one equal to the put value. Highlight all of it, and then go to data table, what if analysis. My column input cell is the risk-free rate. All right, so we've got those. Again, the value of the call increases as the risk-free rate increases. The call value and the put value for an at-the-market option is the same when the risk-free rate is 0. As the risk-free rate increases, the value of that call option gets worth more. The value of the put option goes down. And this is a pretty direct relationship right there. The next one is the time until the expiration date. So again, just going to do the same setup. Oh, that's not good. Okay, there we go. I'm going to put in here. Doesn't want to cooperate with me. There we go. All right. So I'm going to put up here time in years. And you see these moving. They're not actually changing. They just are refreshing whenever I press enter. So I'm going to put this time in years in 1 quarter year periods. So 0.25, 0.50, 0.75, and so on. Okay. 4.75 years is a long time for an option to be out there. And then I will fix that, my mistake on that. Then again, go to data, what if analysis, data table. My column input cell is equal to my time in years. And just like we said before, the greater the time to maturity, the increase, the greater the value of the option for both a call option and a put option. So we certainly see that here. As we go out longer and longer in time, the value of both options goes up. Now, if I change my risk-free rate, let's make that pretty high, let's say 0.07. You can see that the value of the call option increases by more as we go up in years, and the value of the put option increases by less as we go up in years. I'll put that back there to where we had it. Here we go. We have 2 left, dividend yield and volatility. Remember with dividend, make a little graph out here for this one too. So go to insert, and I like these scatter lines. So this is option values and the time to mature to the expiration date. The next one, and you can see here again, just like I said, they both increase. In this situation, the value of the put option increases by less than the value of the call option, with an increase in the time to the expiration date. The next one is the dividend yield. And again, my setup is just the same. I will have my call value and the put value. The let me move this over. There we go. We're going to start with a 0% dividend yield, because a lot of stocks don't pay dividends. And then we're just going to increase it by 0.5% for each level, because dividend yields tend not to get very big. A high dividend yield is really considered anything over 3 or 4%. And we cannot have a negative dividend yield for a stock, because that would mean either the firm is paying a negative dividend, which investors would not go for, or the stock is selling for a negative price, which can't happen either. Oops, there we go. All right, so now I'm going to go to data and what if analysis and data table. My column input cell, again, we call it that because it's the values here in the column. If we had a 2 variable data table, so in other words, we would have one variable along the column and then one variable along the row. And in that case, we'd actually put the number we want to change, so we could just do it for a call or a put, but not both. We would put the call value in this square here, or this cell here. My column input cell in this case is again the dividend yield. And again, what we see here is that as that dividend yield increases, the value of this, holding everything else the same, the value of the call option goes down, the value of the put option increases, because that has the effect on the underlying stock of either decreasing the stock as we go up, and that will decrease the call value, and in the case of the put value, that decrease in the stock price will increase the put value. And here is the graph for that. And just to point out, the value along the x-axis, and all of these are the value that we're changing. So in this case, I don't have a label on here, but it's the dividend yield. And this is the value of the options. Always on the y-axis is the value of the options. Okay, so again, we can see here the value of the put option increases with an increase in the dividend yield. The value of the call option decreases with an increase in the dividend yield. The last variable we're going to look at is that volatility variable. So that is, again, we will put volatility, and this is the volatility of the returns of the underlying stock. So the more the stock prices move, the more the return moves around, the greater the volatility. Okay. And it can go up or down. What I have found is that in general, Okay, certainly not for all stocks, but in general, in normal times, this volatility is about 30%. I showed you Walmart's over 100%, and for a very stable company like Walmart, and that is the result of our very large swings in stock prices over the last few months. So I'm going to start this at, we'll just say 10%, okay, and we'll go up by 5% for each one. Oops. And then we will put in here, oops, there we go. So I put from 10% to 100% for the standard deviation for the stocks, or that volatility, and then I'm going to go out here to data and what if analysis and data table, and my column input cell is once again that volatility number. And as I mentioned before, both the value of the call and the value of the put option increase with the level of volatility for the company or the company's stock. Oops, had that right the first time. And we'll wrap this one up by putting one more graph out there. And, you know, they both go up by roughly, well, by the same amount for each change in volatility. The difference between the two is due to the difference in the stock and the put option value for and in the market or at the market option for both. And actually, if I go over here and I make that risk-free rate 0, it's just one line. Because they both started the same value and they have the same value for every. The blue line disappeared, but it's all in the same line there. Okay, so that's it for the. Actually, one last thing I want to do. Sorry about that. One last thing I want to do. I want to go to these practice questions. So the answers to the practice questions, I actually work them out by hand, but I want you to see that you're going to get a slightly different number. And I'll leave these the way they are so you can just see what it would look like if you would work them out by hand. Question 3 is a good one to know. For each of the following situations, determine if the value of a call option would increase, decrease, or have no change. And it just goes through some of those variables. So I'm just going to throw these inputs in our model here that we created and just show you it's going to make a slight difference and not a huge difference on our outcomes. Here we go. All right. So our inputs here are $38 for the stock price. The call price is the strike price is $40. The risk-free rate's 5%. The time in years is 0.5. The dividend yield is 0. There's no dividend. Actually, I don't know that I have dividends for any of the exercises here. The volatility is 0.15, and the call value is $1.17. Let's look on here what the call value is. The call value doing it by hand, and again, this is happening because we are estimating this. When we do it by hand, we're using that table, and that table only goes out to the tenths power, or the tenths value, not power, the tenths value for that D1 and D2. So it's an estimate. The number you get off of it is an estimate. Well, in Excel, we're getting an exact number. So in Excel, when we work it, we get $1.17. If we do it by hand, we get $1.23, so it's off by about 6 cents. And then the put value, we get a value of $2.18, and on here it's $2.24, off by 6 cents. So just to let you know, the numbers using Excel are going to be a little bit different, slightly different than the numbers I have here. And actually what I'll do is, before I put these documents out online, I'll go ahead and put the answers out using the Excel spreadsheet as well. All right. So again, please let me know if you have any questions about it. There's a lot of information here. If you have questions or you're just curious about any part of it, let me know. I'm happy to talk with you about it or email back and forth about it. I will put out another video going over some of the practice problems, especially for the stock pricing, equity valuation part. If there's anything that we have covered since the last exam and the last exam, I'll need to check to make sure before I put it in the video. In the last exam, if there's anything, so our final exam is just going to cover the material since the last exam that we took. If there's any questions you have about that, let me know. Also, I'm going to be sending out an email tomorrow asking you to let me know if you want to retake any of the exams. And so I need to kind of plan for that in advance. Typically what I would do is just bring, multiple copies of the makeup test, but I have to do something a little bit different because we're not meeting in a classroom now for that. So let me know, and I hope that you're doing well. If you need anything, just let me know about that too, and I will talk to you later.